Hello, I'm Peter Switzer. Welcome to the program that helps you make the absolute most of your money. Time now to ring the bell for Stock Valuation School. And what better example to use than the most widely held stock in Australia, Telstra. If we jump into our time travel machine, we see a tragic decline from $7.20 during the T2 float back in 1999 all the way down to its recent lows of below $3. And analyst recommendations along the way all over the place. I have sitting next to me Roger Montgomery, who will chalk up on the board exactly how he values Telstra. Thanks for joining us on the program, mate.
It's a pleasure. It's nice to be back.
Okay, now last time we were here, we talked about valuations. You said, I'm going to bring something along that will actually make this easier for other people to do. So I have a crack at it. And you said, let's do Telstra.
Well, I've been, as you know, I've been writing about Telstra for many, many years. On my blog, I've been. It's probably the most requested company.
Yeah, well, 1.4 million shareholders.
I think that's right. Yeah, so I think I reckon about 1 million of them go to rogermontgomery.com and ask me the question.
In your dreams, there I go on.
Ask me the question, but. Look, back in 1999, it was almost a darling of the market, and in fact, we were just, as you know, we were just we're on our way to the crest of the internet bubble, and anything to do with telecommunications and technology looked good. All of the commentary or the chat about Telstra was that it was a wonderful company. I remember some analysts saying that it was going to $20 and $30. I remember one bloke saying that it was going to be our first $100 stock. And there was a lot of talk. Now, I don't know...
I bet you remember his name, but you're not going to mention him on my program.
No, that's right. No, because I actually know him. And I always remind him of that.
Yeah, he loves that.
But at the time, you had analysts saying that, you know, it was a $10 stock and it was around $7. You know, there's a quote. We think Telstra is very good value. We've got a valuation on the stock of $7.90. I always, you know, never ask a barber whether you need a haircut. You know, they're always going to tell you. They're always going to tell you that it looks good. Here's another one, and I don't actually know what this means. It's a $10 stock price comfortably in the $7 range. I hear this kind of talk, and I don't actually know what it means. What does it mean, surrounded by pillows?
But these guys could have been selling cars one day, and they're stockbrokers.
I actually don't know what that means, but having said that, clearly the talk at the time was that it was a great company. And of course, and then we had the Telstra, the T2 float, and T2, you know, I think we had John Howard come out, our Prime Minister, and he said it's a marvellous opportunity for more of the mums and dads of Australia to buy shares in this great enterprise at $7.40. Well, those of your viewers who've watched the program when I've been on before know that I talk about intrinsic value. And there's two things. There's the price. And the price reflects what people are prepared to pay for things.
That's the market price.
That's the market price. Then there's what the thing is actually worth. And that's entirely, sometimes unrelated to the price. My job, which I think is really easy, is just to work out what things are worth. Now, I can't predict the share price. But the thing is, back in 1999, the share price, the value of Telstra per share was nowhere near the price. So what I'd like to do is perhaps put up the valuation formula that we use. I don't know if we've got it here. We've got some footage here of Telstra and T2.
I thought for one moment my producer was going to use the little pressing button on that Telstra
to click the valuation.
That would have been really good producing.
It would have been very, very helpful for people who participated in T2 to actually know what the value was.
Yeah, good point.
But the valuation formula is a pretty simple one, and it's return on equity divided by the required return, or the rate of return we're looking for, multiplied by the equity per share. And that's the basic formula for a company that pays all of its earnings out as a dividend. So I don't know if we're going to put it up on the screen for everybody to write it down, but look, if they miss it tonight, they can get it off my blog. And it works really, really well, because nowhere in there is the price. It's just the performance of the business.
And last time you were on the program, you brought up the formula. I said, well, but where do people get the information?
Okay, it's
and
really...
you promised tonight.
Very, very easy.
Easy.
Okay?
Right.
So you take, and I've done it here for another company that we're going to talk about a bit later on. It's really easy. Return on equity is just the net profit after tax divided by the beginning equity. So the equity at the start of the year, and I like to average the equity over 2 years. Well, the equity's in the balance sheet, and the net profit after tax is in the profit and loss statement. It's easy to get. If you're using a full service broker, they're going to give you a research note, and in that research note at the back will be the analyst models, and at the back it'll actually have a row. It'll say company ratios, return on equity will be there. And if you're using an online online broker, you know, one of those. Well,
you don't have any plugs. We know online brokers.
Online
yes.
brokers.
Yeah.
So they
unless there's a new Montgomery online broker.
No, and there won't be. No,
okay.
I'm not in that game. So then on those online broking services, you can actually go on. They've got filter services where you can actually type in, you know, I want to find companies with a return on equity of above 20%, you know, or the top 200 by return on equity. You can rank them and do all that kind of stuff.
Okay, well, just as a starting point, tell people what kind of return they should be. Because you said you have a return figure that you're looking for. What's the return figure they should be putting in, do you think? 10%?
In the funds management, no. In the funds management firm that I ran, I wanted to make a 15% return for my clients.
That's better than the market. You expect the market on average.
Yeah, and I want to get I want to have a margin of safety. So that means I want to buy businesses whose return on equity is much more than the minimum return I'm looking for.
Okay, so your minimum was 15.
That was a pre-tax return.
Okay.
I actually don't use that now. I use an after-tax return. Yeah. So I'm looking for an after-tax return of around 10 or 11%. Okay. That's the sort of return I'm looking for.
Which is the kind of figure that good quality shares can produce. Not always, but can produce.
Yeah, exactly. Yeah. Now, going back to Telstra, back in 1999, Telstra had equity of about 80 cents a share, roughly. And it was generating a 35% return on its equity. And if you're happy with, say, a 10% return after tax on your money, well, the most you could pay for Telstra in 1999 was about $2.70, $2.80, or something around that number.
Yeah, right.
Now, the share price at the time, in 1999, it was on its way to $9 in the early 2000s.
And you said this is la-la land.
Well, this is
on
crazy.
Your valuation method.
Having said that, though, I gave a couple of talks for the Australian Stock Exchange, and I described my opinion of its value and was widely criticised. Of course.
But your whole life is you've been criticised for your work because you're an outlandish kind of person.
By some interesting characters as well who no longer run companies in Australia. So look, the value seems to work. Warren Buffett's been using that valuation formula for a long, long time.
Right.
I've run a funds management business doing it. I don't run it anymore. Of course, I sold it. And I still use that sort of valuation formula today. It works really, really well. Now, fast forward to today. What's the business worth? Well, the business is...
So you use the exact same formula.
Using exactly this... Well, admittedly, I have some bells and whistles on the formula, which takes into account the probability of the performance of the business continuing. And I also have some inputs.
That's a special Montgomery touch.
That's the little Montgomery touch.
It will generate value for you in the future when you start your next enterprise, after you stop gardening.
Yeah, correct. Look at the calluses on my hands from doing the hedge. Okay, and then one of the other inputs is into the quality of the balance sheet and the stability of that balance sheet. And you can actually get some insights into the probability of the company failing by looking at the balance sheet. And so I put some of that information in. So working all that into the black box, you know, and turning it all around and spitting it out, I get a valuation today for Telstra of $3.01. Now, it used to be at $9 and people said it was going to $20, $30 and $100. And I thought at the time it was worth less than $3, worth $2.80 or thereabouts. Well, it's taken 10 years, but guess what? That's where it is.
Okay, so when it was $2.92 this week, you're probably saying, this could be a buy now.
No, because there's two parts, and everyone should understand this. Just because a business is cheap doesn't mean...
I knew what your answer was going to be.
Yeah, right, okay. But just because a company's share price has fallen a lot, and just because it might be cheaper than my value doesn't mean you go out and buy it, because there's two parts to successful investing in my view, and that is part one, a great business. And Telstra is a mediocre business. It generates a very high return on equity, 35%, but it's a capital intensive business and it pays all of its earnings out as a dividend. So it's really like a bond. And in the last 10 years, it's had phenomenal growth in the internet, phenomenal growth in mobile phones, phenomenal growth in subscription-based television. It's had an interest in all those things. And its profit last year was exactly the same as its profit a decade ago. So that's not the hallmarks of a wonderful business. You want a business that's growing its earnings. It's going to be a lot bigger. I can't see how Telstra's going to do that. So even if it's cheap, I may not buy it. It'd have to be at a very substantial discount. Do you want to see these numbers?
Yeah.